Greetings to everyone. You're all welcome to our session today. And here is pros and cons accountancy tutorials. And my name is Edward. You can call me Ed for short, right? So as we began the last time, we want to continue with business combination, basically what we call consolidation, right? Today, our focus is on mechanics of consolidation. So if we can remember, the last time we met, we talked about the meaning of business combination. We just try to understand what business combination is about. We talk about the investment levels. We talk about the situation whereby you earn control over an investee, and also the exemptions to which you may not be preparing financial statements. The exemptions for which you may not be preparing what? Financial statements. So this is what we spoke about the last time. So as I said earlier, we want to deal with the mechanics of consolidation. So when we talk about the mechanics of consolidation, it's simply the components that we need in order to help prepare our consolidated financial account. So what are these mechanics? And I can tell you that in knowing the mechanics of consolidation, it will be easier for you to prepare the consolidated statement as easy as possible, right? So what are these mechanics? One, we have the group structure. We have the group structure. What is the group structure? So the group structure shows how what percentage that has been purchased from, or the investment level from the parent, and what the NCI. Because if we have, let's say, pros buying cons, remember cons already is 100% company, right? So whatever pros is buying, if let's say pros is buying 60%, the group structure between them is 60-40. Will then be what? 60-40. So pros, who is the parent, will hold 60, whilst the NCI here, not cons again, because it is the cons company which has been separated into parent, right? And then the NCI, because if you purchase 60 out of it, whatever is left, we call it the non-controlling interest, the interest that pros does not control anymore, right? So we are going to have parent and then the NCI company. However, cons itself is the 100% subsidiary, which has been distributed into parent and then the NCI. Parent and then the NCI. So basically, this is the group structure. So the group structure is just going to show that pros is purchasing what? 60% of cons. Then in that case, it means pros being the parent is purchasing 60%, whilst the NCI, which is a non-controlling interest, is having 40%. So in together, it becomes the cons company, which was 100%. This is our group structure. So in terms of the mechanics of consolidation, this is our group structure. This is our group structure. Let's have a scenario based, basically a full question, and bring out what the group structure from it. So let me share this with us. So we have this. There's a full question where they are saying that on 1st October 2010, Cheddar secured a majority share of Oba on the following terms: an immediate payment of 4 per share on 1st October 2010, and then a further amount deferred until 1st October 2010 of 5,004 or let me say 5.4 million. That is not where our focus is. We want to know the group structure. So what then is going to be the group structure, right? So let's look at note one, or not note one. Let's look at this note. So they say on 1st February 2010, Cheddar also acquired 25% of the equity share of Fosty. So 25% means Fosty will be Cheddar's what? Associate, right? Fosty will be Cheddar's associate. All right. Paying 10 million in cash, and then Fosty made a profit of 1.2 million. So if you want to find the fair value, what are we going to do? We are only going to have the 10 million that Cheddar paid in Fosty plus their share of the profit, and the profit is 1.2. So we just multiply 25% on the 1.2, right? During our explanation of the investment levels, we made mention that you have to find a fair value of the investment in the associate. That's not where our focus is. So we want to get the group structure. Let's see how we are going to get a group structure. So if you look at the financial statement, right, this is supposed to be Cheddar and this is supposed to be Oba. So if you look at the financial statement, it means Cheddar purchased what? 8 million shares in what? In Oba. 8 million shares in Oba. Sorry, this is supposed to be Oba. So Cheddar purchased Oba and also purchased what? Also purchased Fosty. So the Augusta, as you see here, is supposed to be Fosty, whilst the Saracen you see here is supposed to be for Oba. So Cheddar purchased 8 million in what? Oba. And Oba has how many shares in their company? Oba is having what? 10,000 shares, right? This is statement, so this is a value. But how do we get to know the shares of it? The shares of it, we will have to use what? The value that we see here, right? The equity shares is at 1 cedi. And if it is 1 cedi and we have 10,000, it means the shares to is what? 10,000. The shares to is 10,000. So simply put, it means Oba has been, Cheddar has purchased what? 80% of what? Of Oba. Cheddar has purchased 80% of Oba. So in this case, we can say that our group structure is Cheddar, who has purchased Oba. And that is what? 80%. How did we get the 80%? Looking at the statement, Oba purchased 8,000. Cheddar purchased 8,000, whilst Oba is having a 10,000 shares. 10,000 what shares. So I purchased 8,000 shares whilst you have 10,000 shares. So if you multiply this by 100, we are simply going to get what? 80%. And that is why we are saying Cheddar has purchased what? 80% of Oba. All right, so basically that's how to come out with your group structure. There are some questions that will give you the group structure straight. It will give you the percentages straight. But there are some questions that you'll be given the shares for you to convert into what? Into percentages. So we can take note of that as well. Now let's look at the next mechanic, which is date of acquisition and then date of reporting. So date of acquisition and then date of reporting. So when did you acquire the company? When is the reporting period of the company? So let's go back to the Cheddar and Oba question once again and look at how we can pick these figures. Now, when did Cheddar purchase Oba? They said on 1st October 2010. And then the reporting date, as the question is given to you, is what? 30th September 2010. 30th September 2010. You purchased the company 1st October 2010. 1st October 2010. So on 1st October 2010, Cheddar secured a majority share of what? Oba on the following terms, right? So 1st October 2010 is the acquisition date is the acquisition date. So in that case, this is supposed to be 30th September 2011. September 2011. That will give us 1 year. That will give us what? 1 year. So sorry for the 2010. It's supposed to be 2011. Let's look at the question once again. They purchased the company on 1st October 2010. 1st October 2010. Sorry. So this is supposed to be rather 1st October 2009. 1st October 2009. Sorry for the mistake. This is 1st October 2009. So the acquisition period is October 2009. The acquisition period is October 2009. So 1st October 2009. Right, 1st October 2000. And the ending period is 30th September 2010, 2010, giving us what? 12 months. So giving us 12 months. So October, November, December, January, February, March, April, May, June, July, August, September, which will give us what? The 12 months. So it means our post-acquisition period is 12 months. Our post-acquisition period is 12 months. What do we mean by the acquisition period? The acquisition period is the date we are acquiring the company. And this is what 1st October 2009. And then the reporting period is the date we are going to consolidate the financial statement. Right? The date we are going to consolidate the financial statement. And that is what 30th September 2010. Looking at this question, we were being given 30th September 2010. We have to consolidate at 30th September 2010. That is the ending period of these what companies, 30th September 2010. So, what is the post-acquisition period? So when we talk about post-acquisition period, is it the period from acquisition to what? To reporting. How many months do we have there? How many days do we have there? How many years do we have there? That is our post-acquisition period. So our post-acquisition period in this case is 12 months, which is 1 year. 12 months, which is 1 year. So if you are supposed to find out the date of acquisition, date of reporting, at the end of the day, if you get a 2, it should tell you your post-acquisition what? Period. The post-acquisition period. All right. Now the next mechanic is our cost of consideration or purchase consideration. And talking about purchase consideration, we have about 6 types of what purchased consideration. We will list all of them. If there's time, we will talk about some of them. Then another day, we can also talk about what some again. So one is cash consideration. Cash consideration. 2, we have deferred consideration. Deferred consideration. 3, we have contingent consideration. Contingent consideration. We also have transfer of assets, or let me say transfer of a PPE. Transfer of a PPE. We also have loan consideration. And we have share exchange consideration. Share exchange consideration. So each of this has a way of dealing with it, right? So when we talk about the cash consideration, that one is just about paying cash. It's just about purchasing the company. Then you pay cash, you go your way. So it will not have much workings to be done over there. It's just the cash, and that will be our consideration for the period. And that will be all, right? But when we talk about deferred consideration means I purchase your company today, but I do not pay today. I decide to pay in future, meaning I have deferred the amount. And because of time value of money, we will have to find the present value of that money today. Because the full amount we are talking about is what you are going to pay in future. So let's bring it to the present today. Then we get to know how much it's going to be today. And that's what we call the present value of the money. The total amount is what has been deferred, right? But we want to find it in today's terms. And by so doing, you have to bring it to the present value. Now, the difference between the present value you are getting and the full amount becomes a finance cost. Becomes what? A finance cost, amount that you are going to use in financing what? The present value you have today so that you can get a total value in future. So we call it a finance cost. Surely we are going to deal with something like that. So we'll get to know how deferred consideration is also prepared. When we talk about our contingent consideration, it simply means that the amount is basically not different from deferred. It's also something you are going to pay in future. But this time you are going to pay based on or contingent on the fact that the company achieved something which was agreed. Normally it's about the company making profit. So I will pay you this amount, but I will only pay you if you start making what profit. If you are not making profit, then I don't pay you that amount, right? If you are not making profit, then I don't pay you that amount. So if you are not making profits, there's a possibility that I'll pay you something less. I'll pay you something less. Even though we have agreed on, let's say, 2,000 today that I'm going to give to you in future. But the agreement also is that if I'll give you this 2,000, you have to be making profits as at that date, right? If you are not making profit, I'll pay 1,500. I'll pay 1,000 what? 500. So in future, even though we have agreed on 2,000, but in future, I'm going to pay you what? If you do not make profit, I'm going to pay you 1,500. Then it means I've gotten what we call gain on a bargain. Gain on bargain. So that 500 becomes a money for me to chop. It's a gain for me. Instead of paying 2,000, because you didn't achieve the objective or the agreement, I'm giving you 1,500. And therefore, that 500 is a gain to me. So that gain on bargain will have its effect in the parent what? Account. In the parent account. So simply, that is contingent consideration. Now, when we talk about the transfer of PPE, so transfer of PPE is about transferring an asset instead of me giving you cash or even saying that I want to defer the consideration or talking about contingent consideration. I want to rather give you what? An asset to cover what? How much? To cover how much I'm supposed to pay to you. So I can give you a motorbike, and that motorbike should represent what? The consideration that I'm supposed to what? Give to you. Right. And in that case, if I am transferring to you, then I transfer using what? Using the fair value of the amount. So when we talk about fair value, it simply means the market value, how it's being sold at the market. As at the time I'm giving it to you, how much is it in the market? That is what the fair value of the asset. So if how much I was keeping the asset in my book before the transfer is lower as compared to the fair value, then what am I getting? It means there's a certain gain over there, right? There's a certain gain over there. So let's say I have this phone and I'm going to give you this phone as a consideration, right? So I go to the market and this phone is being sold, let's say 1,500. But in my book, the phone is 10 is 1,000. In my book, the current amount of this is 1,000. However, our agreement on the consideration is 1,500. So if I'm to give you this phone, I have to add another what 500 because for me in my book, I value it at what 1,000. So if I give you this phone, I have to give you what another 500. However, we went to the market and we got to know that this is 1,500. So I will give you only the phone, which is 1,500, without giving you any other cash. So in that case, we say you have also gotten what? A gain of 500 because something that you were keeping it at 1,000. Here be now you are getting what? You are getting you are getting what? You are getting it at 1,500 as the consideration, which was agreed on. Having to make, surely you've made what? A profit of 500. And that's what we're talking about. So you are having a profit of 500, which also go into the parent's account. It means the parent has made a gain from what? The consideration. That's all. That's all. So that is the idea of transfer of PP. So the vice versa also work for where the asset is being kept in my book at a higher amount as compared to what? As compared to the fair value in the market. In that case, we'll be making a loss because we will have to add up some amount to the person. All right. Loan consideration. So for loan consideration, it's most of the times funny. I'm coming to purchase your company, then I tell you that, well, give it to me on loan, right? Give it to me on loan. So give me, let's say, 10,000 shares, but give it to me on loan, I'll pay, right? And for every, let's say, I'll say for every 100 shares that you are going to give me, the loan is going to be what? 20 cedis. The loan is going to be 20. So you have some money with me. It's a loan. You have some money with me, which is what? Which is a loan. Even though you've given me the asset, or you've given me the shares as my shares from your company or my percentage from your company. But there's a loan that I need to what? I need to settle you. There's a loan I need to settle. You gave it to me on loan. I didn't pay. You gave it to me on loan. And we didn't agree on any deferred or any contingent. So it's a loan that you've given to me, and I'll have to what? Settle you. As I said, we are going to deal with all these things. So it shouldn't be an issue for us at all. Then we talk about share exchange consideration. So the purchase that I'm purchasing your company, I'm giving you my shares to purchase that company. Instead of me giving you cash or anything, I decided not to give you cash. I decided not to talk about deferred, not to talk about contingent, not to give you my assets, not to say you should give it to me on loan, but rather what share exchange. So I have some shares in my company. Let me give you some, right? So that it will term as what? It will term as my consideration that I'm giving to you. The whole idea is, if let's say I'm supposed to purchase 2,000 from your company, 2,000 shares from your company, which is going to cost me about 40,000. I'll give you equivalent of my shares, which is equal to what? 40,000. Equivalent of my shares, which is equal to 40,000. I'll give it to you so that it will represent what? The 40,000 I'm supposed to pay to you. Then that will be all for your consideration. So basically, this is the types of considerations that we have. Let's go on and talk about other mechanics. As I said, for group structure and then date of acquisition, date of reporting, we may not be coming there again. But for purchase consideration, we'll be dealing with it in our subsequent lecture, because we have to talk about deferred consideration, contingent consideration, transfer of PPE, loan consideration, and then what? Share exchange consideration. So we'll be talking about all these one by one, because I don't want us to miss anything on this. Consolidation isn't difficult, but you can make it difficult for yourself. You can really what? Make it difficult for yourself. And we also have to understand that this group structure that we have, this is the simplest group structure that we are going to get, right? Normally, if you are writing CA and then ACCA, this is just for level 2 people. When we go to level 3, we will have different other ones where we will have even the D shape, we will have the V shape and the rest. So God willing, when we meet in our next session, I'll talk about group structure once again. Then we talk about the purchase consideration and move on to other mechanics. But today, let us mention the other mechanics that we have. So aside our purchase consideration, we will have what we call net asset of the subsidiary. Net asset of the subsidiary. So in talking about net asset of the subsidiary, we because we are going to purchase a company, we want to know their net asset that we are going to purchase. So we will have their total asset less what? Liabilities. Less what? Outstanding, any outstanding liabilities that they need to pay. Or sometimes if they give us the asset, we have to go to the market and find out if this is what the fair value of the asset they've given to us. So we find the fair value of the asset they've given to us, then we do what? We subtract any outstanding liability that they had to pay. That becomes what? The net asset of the subsidiary. But this net asset, we look at the net asset at acquisition, at reporting, and at what? Post acquisition. So we are going to get net asset at acquisition, at reporting, and then at what? Post acquisition. Post acquisition. So in dealing with net asset of the subsidiary, we will have acquisition, reporting, and then post acquisition. So we want to know, as at the time that we were acquiring the company, what was their net asset? And at reporting to what is their net asset? The difference gives us what? The post acquisition what? Profit. Post acquisition profit. So acquisition, reporting, and then post acquisition. Now, what we should have in mind that when we talk about net assets, it can be their total equity less liability. Total equity less what? Liability. Total equity less what? Liabilities. Or we can say total asset less what? Liabilities. Right? Less liabilities. In consolidation, normally we are going to use the equity section. When we start solving question, I will explain why we are going to use the equity section. Because if an asset is given to you, a current asset, non-current asset, is given to you as what? Total asset. Right? Whenever a statement is given to you, the asset given to you is the asset at the end of the year, but not beginning. So if we are supposed to use total assets, we are only going to get total asset at the end of the year, but we'll not get at the beginning of the year. Right? Okay. But if we are using the equity session, equity session, we will surely make changes to the equity in terms of retained earning, in terms of reserves, all these things, we are going to make changes to it. Then at the end of the day, we get what? We get at reporting. So for equity, we are going to get equity at the beginning and equity at the end. However, the asset which has been given to us in the statement, it is only asset at the end without asset at the beginning. So if we use assets as assets in the financial statement, it will be very difficult for us to get that of the beginning and the end. But with equity, we can get equity at the beginning and equity at the end. As I said, we are going to solve questions on this. We will have scenarios and questions to solve. So surely we will understand why we have to use equity instead of what? Asset. Instead of asset. Well, our next mechanic will be the goodwill. Our next mechanic will be goodwill. So when we talk about goodwill is basically how much we've used to purchase a particular company and how much of assets did we get. So goodwill is consideration as compared to what? The net asset at acquisition. Oh, how much asset did we purchase? How much asset did we get? How much asset did we purchase and how much of consideration did we give out? But in any time when we talk about goodwill, because the purchasing companies is between the parent and then an NCI, we think about a certain policy. We think about a certain policy. And that policy is in two folds, where we say the fair value policy or the proportionate policy. Proportionate policy. You say that we are talking about the fair value policy or the proportionate policy. What is the fair value policy? So the fair value policy talks about where we want to find the overall fair value of what the company at acquisition, as well as the overall fair value of the amount we are using in purchasing the company. So in this case, both the parent and the subsidiaries amount together. Both the parent and the subsidiaries amount together, right? Then we compare with the total amount of assets that both of them were purchased. Then we get what we call a goodwill, right? Also, in talking about the proportionate, it simply means that we are dealing with only the parent's goodwill. So the goodwill we are going to calculate only belongs to the parent. But when we talk about the fair value, remember we are adding both the consideration of the parent and that of the consideration of the NCI. So when we add these two together, we get what? The total consideration that we use in purchasing the 100% of the subsidiary company. Then we compare with the 100% of the subsidiary what? Net asset at acquisition. But in talking about proportionate, we are comparing the parent's share of the net asset at acquisition as compared to what the parent what consideration. So in that case, we do not consider what the NCI, the NCI, right? So we are going to, in talking about fair value, the idea is going to be parent consideration as compared plus the NCI fair value or NCI consideration. Then we compare this. So this becomes your total consideration, the 100% total consideration as compared to net assets at acquisition of what? The sub. So this two gives us our goodwill. It gives us our goodwill. Always know that goodwill is prepared at the beginning of the year. Goodwill is prepared at the beginning of the year. So this is the fair value policy. What about the proportionate policy? So for the proportionate policy, we say it belongs to the parent alone. The goodwill we are preparing belongs what? To the parent alone. Then we have the parent consideration. The parent consideration will now be compared with the parent's share of what? Net asset at what? Acquisition. Acquisition. So net asset at acquisition of what? The sub. When we compare this, we get the goodwill. And we say this goodwill only belongs to what? The parent. Only belongs to the parent. So if the parent acquired 60%, we will just multiply the net asset at acquisition by 60%. By what? 60%. And that will be all for us. That will be all for us. Right? Then we compare that with the parent consideration that they pay to get our goodwill. Then in that case, what we should have in mind is that because it's a goodwill and goodwill can be impaired, right? It can be impaired. Goodwill is an asset, so it can be what? Impaired. Once it is impaired, anytime there's an impairment, where the policy is proportionate, then that impairment only belongs to what? The parent. Only belongs to the parent. So if there's an impairment, we will just add impairment here. We will just subtract our impairment. We just subtract the impairment. Then we get the actual what? Goodwill on consolidation. The goodwill on consolidation. Here, if there's an impairment, yes, we still subtract impairment. Impairment. Then we get our goodwill also on consolidation. But this impairment, at the end of the day, will be shared between what? The parent and then the NCI. So it will be shared between the group retained earning and the NCI account. And the NCI account. You will be preparing an NCI account and will also be preparing a group retained earning. So where there's impairment for fair value policy, then we'll have to share it between the NCI and the group retained earning. But where we are using proportionate, then the impairment only belongs to what? The group retained earning, which is assumed to be the parent what? The parent account. Parent account. Surely we are going to deal with a question which will help us to prepare a goodwill based on any of this based on any of this policy. So what will happen is even if we have a question which is talking about fair value, we will try as much as possible to deal with it in a proportionate way. If the question is also talking about a proportionate way, we will try to deal with it in a fair value a fair value way. All right. One thing we should also know about goodwill is that we have a negative goodwill and a positive goodwill. You you can only get a positive goodwill, and that positive goodwill is termed to be what? An intangible asset, where the payment is higher than the asset. The payment or the consideration is higher than the asset that you acquired, right? In that case, you have an intangible asset goodwill, which is a positive goodwill. Now, the negative is the asset, uh, um, um, where the asset is rather higher than the payment. It means we're giving you something more. It's a gain that you've gotten, even though the name is a negative goodwill, but it's a gain that you've already gotten. We say take that gain to what? Your P&L. Take that gain to your P&L. So we have a negative goodwill, which will go to our P or L. And then we also have a positive goodwill, which is termed as what? Intangible assets. And that is the only goodwill which can have what? Impairment, intangible assets. That's the only one. The positive one can have impairment. But if it is negative, it is something you are taking to your P&L. So there's nothing what? Impairment anymore. It's a gain you are taking to your P&L. Let's be careful with the name. Because the negative one is seen to be a gain to the P&L. And the positive one is seen to be an asset in your financial position. Okay, so last but not the least of the mechanics is your group retained earning. Simple and short. Your group retained earning is talking about anything about the parent. Any cost or gain that the parent gets goes into the group retained earning. So this one, that if we had a negative goodwill, it would go through the group retained earning, right? To go through the group retained earning. The parent may have invested in another company, an associate, and gotten a gain or gotten a certain impairment. It will come here. Or gotten a certain profit, it will still it will also come here. So that is the group retained earning for you. So the group retained earning, surely every earning from the parent side will come into the group retained earning. So talking about the parent retained earning that we may see in the financial statement given to us, we will start with that. Then after after the net asset schedule of the subsidiary, surely we have post-acquisition profit. So that post-acquisition profit, because the company is for now the subsidiary, which is the 100%, is now for the parent and then the NCI. That post-acquisition profit will be shared between the parent and then what? The NCI. So that one too we will have it here. Right. As I said, if we get a question, we will surely get a question and deal with all these issues. The last but not the least of the mechanics that I want to talk about is, so we have our group retained earning, and the last, which is the 7. What is the 7 even about? Now we've talked about our group structure. We talk about our date of acquisition and reporting. We talk about our purchase consideration. We've talked about our what was the 4? Net asset schedule. We've talked about the goodwill. We've talked about the group retained earnings. Surely we will have the NCI, the NCI. Normally we prepare the NCI account before the group retain earning. But it's not by force, so please, you can exchange the two. So the NCI account is basically the fair value of the NCI. And that fair value of the NCI is what we used in preparing the retained earning, the goodwill when we're using the fair value model. The goodwill when we're using what? The fair value model. Then afterwards, if there's any impairment which came as a result of the goodwill when we're using the fair value model, we share between the group retained earning, which we assume to be the parent, and what? And the NCI account. Because the goodwill now belongs to both of us. So if there's any impairment, we share. Right? If there's any impairment, we share. However, if the goodwill is only for the parent, then there will be no impairment for the NCI. There will be no impairment that we are going to share for the NCI. Also, remember when we were talking about the group retained earning, we said the post-acquisition profit is for both of them. So the NCI will take their share. NCI or what will take their share. So it means with the NCI, we are going to get the fair value of the NCI. Then we get if there's any impairment where we are using the fair value model and there's any impairment, it will come here. Then we take their share of what post-acquisition profit. Post-acquisition profit of what? The sub. Then we also bring that here. So that will give us the NCI account. But where we are not using the fair value model, then simply the impairment will not come. The impairment will surely what? Not come. The impairment will surely not come. But where we are using the fair value model, then if there's any impairment, it will be shared between the two of them. Right. So this is the mechanics of consolidation. We are going to deal with it one by one in our subsequent videos, where we'll be starting with the group structure and the purchase considerations. For the group structure, it's something simple that we will deal with. Then we will talk about what the purchase considerations, also one by one for us to understand. So this is where we will end it for today. Our subsequent lectures, as I said, we are going to deal with the mechanics one by one so that we can enter into it and gain more understanding and also be able to apply on questions and any other scenario that we may have. All right. So here remains pros and cons, and my name is Edward. You can call me Ed, that is for short. And if there's any other issue, please, once you watch our video, you can comment, right? We will be grateful to hear from you and also be in touch. So at this juncture, please, and please again, kindly subscribe to our page and then share with friends and family who are doing ICA, ACCA, any other professional courses. You can share with them, our accountants, anyone, so that they can also have a feel of what we are doing. Also share to them to also like and subscribe our videos, right? So that we can also grow and grow with you as well. So this is where I say goodbye to everyone. God willing, we are going to meet. Bye-bye.